Great. Look, thank you very much, Greg, and welcome everybody to this webinar. Some of you may well have been to our series earlier this year as we were explaining the development of our Lender Ready program. Others of you might be new starters. What I propose to do today is that the operational and practical elements of getting money from a bank is, I guess, one of the things I know that some of our clients find difficult to handle and to understand. And also they, in some cases, don't necessarily understand that life has changed over the last few years. So rather than me giving an insight from my perspective, based on the work we've done with clients and also some of the research in establishing our Lender Ready program, I've invited Kylie Morrow, who's a senior agribusiness manager from Dubbo, who actually straddles 3 states in her work, to join us to give us, I guess, a practical insight into what's going on now and what she would look for in dealing with her customers, as well as both of us looking a little bit over the horizon into some changes that are coming. So Kylie, welcome. And is there anything about you that we need to know that I haven't already quickly summarised?
No, thank you, Gordon and Greg. Great to be here today and having a catch up. A bit about myself. I'm currently based in Dubbo, have been back in the Central West New South Wales now coming on 3 years. Originally cut my teeth into banking in Southern Western Australia, and over my course career have focused mostly on looking after family farms in many operations, and my goal is just to how can we make banking easy and for businesses to achieve their goals. So excited to be part here today to have a chat about it.
Great, thank you very much, Kylie. So to provide a bit of context, we have actually developed this Lender Ready program in a couple of forms, which is being rolled out. It's part of a wider Meat and Livestock Australia AgForce Queensland Government partnership, where we're looking at providing professional development opportunities to support more around better business management and how people might grow their businesses. And I always make the distinction that this is somewhat different from production, but not necessarily divorced. In my mind, though, I've got kind of the business management, what we call internal profitability in one part of my thinking, then I've got the production side in another part of my thinking. So what these webinar programs are about are principally to keep people informed, to understand what I regard as a very important element of getting money from lenders, which is to actually understand what the wants, needs and drivers are of lenders, because that will give you some understanding of how best to engage with, we'll call it the person. So here we have Kylie as the person, but then Kylie is representing the wider lending environment of her employer. And they have policies, procedures and so on, which are all part of the decision-making process. So that's really what this and the Lender Ready program webinars are all about, is to keep giving people insights into things that might change. So this was a question that Kylie and I discussed the other day when we were, I guess, thinking about the focus of this webinar, which will come up in a minute in the agenda. So the question was, if I'm lending you money, these are the things I want to know. So Kylie, I'm just going to ask you maybe to put this into your own words, because it's sitting up there on the screen and they're fairly pithy sort of observations. So could you just elaborate on those points?
Yeah, it's I guess when I'm personally lending money, even though it's not coming out of my back pocket, I treat it as though it's coming out of mine. So if I'm lending you, Gordon, some money, I'd like to know, what are you using it for? When will you be giving it back to me? How do you plan on bringing the money back and earning the funds for that? And what can go wrong along the way? And whilst you can't plan for everything that can go wrong, what have you thought about if a certain aspect goes wrong? What are you going to do about it to still come back and repay me at the end of the day?
That sounds pretty good to me, Kylie, because that's pretty much the structure that we've tried to use with the Lender Ready program. But I really think, I've heard this so often from lenders, it's better to actually be almost that blunt. So thanks very much for that, Kylie. And I just wanted to use that to set the scene. So let's now move on to our agenda. The first thing is, and this was a conversation you and I had some months ago, Kylie, where we looked at this little diagram. So it's you and your business partners in the middle. It's the bank, the solicitor, and the advisors who are all part of the deal. So I'll get you maybe to explain that in a moment when I define our agenda. So we were thinking the lending environment has changed, and it is keeping on changing. And you and I talked about implementation of business best practices being a key element. We've talked about the importance of, almost as you've touched on already, standing in a lender's shoes to understand those wants, needs, and drivers. We've also talked about business risk, and those three things are really the important elements of this conversation. And then we're going to touch on these golden rules around risk to demonstrate that people understand what risks are and how they're managing them, and how that can be built into regular reviews. So Kylie, that's a lot to cover, but I know you really love that diagram, so why don't you start there and maybe make some comments about why it is that we've put this agenda together the way we have.
Yeah, Gordon, I think it is one of my favourites because as a producer, you can be the jack of all trades, master of none. So what people need to focus on is to say, what are my skills and strengths? Where do I fall short? And bring in external parties to then complement on that. Now, in cases of a bank, solicitor, accountant, they're generally specialised professions within that. So we need to ensure have good open working environments. And then from the advisory front, looking from a production point of view, as well as a business model as well, similar to what you provide in your marketplace, Gordon. And the harmonious relationships are when we see this picture coming together, that all three or four parties around the outside have the customer at the core of everything that we do. And so leaning into each area and expertise. And it's also healthy for each of those pillars to challenge each other, because ultimately what we're trying to do is get the best out of that for the customer at the middle. A lot of the items that we'll go through today are things that us as a lender need, but ultimately they're things that should be discussed within business and those risks themselves. Leaning into that, implementing of that, what does best practice look like? From the lending point of view, these things are continually changing. Gone are the days when it was done on the back of an envelope or a beer coaster and a decision was made in office to different regulatory requirements that customers as well as lenders have to now cover. And also thinking about what can go wrong, whilst at the moment we're in a pretty positive environment, which is fantastic from seasonal and prices. We've got to remember it wasn't so long ago that unfortunately we're in a pretty challenging position from the environmental and price perspective. And it won't be into the future, it'll come around again. So what are we doing to put measures in place to protect against that?
And I think you've set the scene quite well, Kylie, because that's why I guess we were thinking about this agenda being the way it is, which is, I guess, reminding everyone that if they demonstrate business best practice, then when they understand what drives a lender, which is business risk, then all elements of business risk, if they're covered, I guess gives you greater confidence that the proposition being put forward will actually work, and that will be checked in on an annual basis. Is that broadly how I'm seeing it?
Yes, no, I agree. And annual is probably the absolute minimum, whether it's tied into, say, a bank or a financial review. But it can be brought in on either ad hoc or a quarterly or a seasonal basis, would be leaning into that best practice.
Okay, so if we're talking annual reviews, that's kind of the minimum that from your point of view. And if I put my hat on as a business advisor, we're also advocating that people, at least on a monthly basis, run, for example, a management advisory board, or quarterly basis, do a more formal financial review. Is that kind of fitting with what you're thinking?
Absolutely.
Okay, great. Well, Kylie, the first of our agenda items was this implementing business best practice. And as we were going through our thoughts for how we would run this webinar, we thought the logical place to start is our ABDI 12 Pillars of Business Best Practice. So if people look in the bottom left-hand corner there, they can actually see our website. And there's a little bit more elaboration in writing terms about what these 12 pillars are. So Kylie, I'm thinking if I quickly run through these 12 pillars, you might comment at the end and kind of pick up some points about each, or maybe some highlights. Does that work for you?
Yeah, fantastic.
Okay. So in my terms, and this is what we tend to work with in terms of our clients, which is pillar number one is where are you going? How are you going to get there? We talk about a clear end in mind, a clear end game of having, say, a 3-year, 5-year plan. We break that also down into a 180-day plan. So it helps define exactly what the journey is going to be and how you check in as you go there. Marketplace, the way we look at this is the only time you make money is when you sell a product to a willing customer. So therefore, it's important to understand who the customer is, what the product is that they need and want and are prepared to pay a premium ideally for, and what some of the variabilities are in the marketplace that might cause you to come unstuck or provide an opportunity. Pillar number 3 is the corporate mindset. And I do remember we've got a CEO mentoring program which we run from time to time. And a number of people who called me about that program said, look, mate, I'm not the CEO of a business like they are in mainstream. And I said, well, when you stop and think about it, if you're running a multi-million-dollar enterprise, a CEO running the show, a mini corporate mindset, what we call size appropriate, is quite critical to your way of thinking. Which leads us on to pillar 4 about financials, which is understanding how, I guess, the CEO or the corporate mindset looks at running the financials in a business to demonstrate it's a high-performing, low-risk business. So there's a fair bit of discipline required around those financials. People, we always talk about a business owner making themselves redundant. And the only way you can do that, and by redundant I mean they might choose to go off and do something else, or they might choose to go and work on the business more. The only way they can do that is to have others who help run the business. And the logic behind that is that people will then run the business according to systems, which diminishes risks, maximizes efficiency, and allows, I guess, the business owners to get off the tools. Which leads us to, I usually link pillars 7 and 8 together, because business risk, as opposed to production risk, which we'll be talking about in a moment, is often very tangible, sometimes intangible, the things that might cause us to come unstuck. And I roll it into legals because in today's marketplace, we have to be very aware of our obligations, which is where, to me, governance comes in as well. Succession, we prefer to call this business growth and transition. The idea of setting your business up so it can actually be sold, or we can make ourselves redundant, or we can actually build a business so we focus on the business building process rather than the daily operations. And inevitably, money has to come into the business. People go in and out. So they're, to me, the elements of succession. How you might work with others, pillar 10, and how you can collaborate effectively. Sales and marketing, which is something that we often don't think about, which is about, I guess, positioning our product so that those higher value customers or even commodity customers think of us first. And finally, communication. How do we communicate about our business goals and aspirations to people like bankers or our accountants or our advisors? But how do we communicate efficiently and effectively within the business? So that's where systems, communication, teams, the corporate mindset, all those elements come in, particularly if we're going to communicate the end game, pillar number 1. So Kylie, that's my quick summary, but I know you made a few notes about those points in terms of what a banker would look for in terms of what works or doesn't work. Any thoughts?
Yeah, Gordon, when you ask me what are the risks that you look at as a lender going through a proposal, I started making a list of what are the things that I look at, and then I was on your website and realised that best practice, these 12 are a great starting point. And so looking into your own business as well as then putting a proposal together through a business plan or a conversation, by addressing things that can potentially go wrong in these aspects, or where can the business grow further, is a fantastic starting point. And it's also helpful to understand that every business is going to prioritise these in a different way, and that's also going to change as the business life cycle goes on. So just because we address it today here in October 2021 and the business is at a certain stage, you're at an age, doesn't mean that's set and forget forever. So it's also that fluid check-in on that minimum annual basis to say, is this still my current priorities? And being open to potentially change those into the future. A couple of the things, whilst we cover off on everything, things to then think that cover into the finance as well as the business side is what are the market that I'm dealing with? What am I producing? Is it a bulk commodity? If that's the case, how can I value add my commodity to get closer to the end consumer, which is generally where you're going to make that value add and additional money. If you're going down that path and landing into, say, a highly concentrated business and focusing just onto one or two customers, what does that look like, and how will your business survive if one of those were to be removed? And what's that backup plan? So to say, look, I'm a cauliflower producer, I'm supplying into Coles and Woolworths. What happens in the event that one of them change the contract terms that I don't feel favourable anymore? Who is there in the market that I can potentially approach to replace them? Or how am I going to position my product going forward? So it's continually thinking about from those. Working through, so from a financial perspective, it's access to, have I got enough cash flow in my business to achieve what I'm looking to do on a day-to-day basis, to make the money to ultimately repay the bank, and risks also within that, protecting of your cost of funding. We've seen interest rates over the last 10 years on the downside. So it's a great time just to continually review those and say, am I in the right structure? And that's where you can lean into your bank manager to get the guidance on that. So to say, Gordon, I could spend all day talking on each of these points, but I won't take up the time. But it's just get those starts to think about where to lean into for your own business, as well as when putting a finance package together.
Sounds good, Kylie. And look, I was listening to you and thinking of a few questions myself about things that we could elaborate on further in our program and even further webinars. But equally, it might be something that people have their interest have been piqued as a result of listening to you talk about those things. So they may be the sort of things we can cover according to questions when we get to that point in the webinar. So thanks for that. Let's now move on to agenda item 2, which is thinking about what's most important to lenders. So, I mean, I'm not a lender, but this is kind of where my research has ultimately led me. And I know, that there's talk about 3 C's and there's talk about 6 C's. So I've taken the 6C approach. I've put all risks in the middle from the point of view of what you and I have talked about. Then I've put we'll call it the people issues, capacity, character, capability on one side. And then I've put the collateral, cash flow, and clarity about finances, business on the other side. But I'll get you maybe to comment about that briefly within the framework of where we're going to head to, which is the risks. And maybe if you comment on the diagram first, and we'll deal with that risk on the left-hand side a bit in a moment.
No, thank you. And and this is something that through putting applications together, we come back and address. I guess in a banker's world, it's the five C's of credit, but I love the point there of clarity at the end of it. So just working around that, the things that we want to be looking at is capacity. What is the borrower's ability to repay their loan? Are the assumptions that this is being based on, i.e. cash flow projections, are they sound? And is there sufficient funds to then be able to repay the debt? And also within that, probably a bit of the willingness as well. Does the person I'm lending the money to have the willingness to pay me back, or do they just want to grab the money, run and never return it? So things that we've got to question, which leads into character. What's the reputation? So we want to make sure that we're lending to reputable people from that perspective, and removing. We hear some bad things in the media when banks and the corporate affairs teams can get caught up being involved with some risky, dodgy characters. So one thing we just want to make sure everyone's, I guess, as clean as possible. The capability are the skills there to achieve what you set out to achieve. And if you're only new into an industry or changing a geographic location, even if you don't have the full skill set to do it yourself, understanding who have you got as advisors around you, coming back to that team at the start to help you achieve what you've got and upskill from that perspective. From the collateral, what assets are there to secure the loan? Layman's terms, if all the wheels fall off, what can then be sold up to repay? And from a cash flow point of view, assessing what are the assumptions based from a production side. So it's not, when preparing a cash flow, it's not just saying I'm going to have $1 million of cattle sales. What we actually want to understand is how many head, what's the weight, what price per kilo, and those assumptions that then build back up into that top dollar as well. It's just doing a sanity check because it's to understand, are those realistic expectations and of what's being set out to achieve? And at the end of the day, it's all wrapped up with clarity. As a borrower, do you actually have an understanding of that clear vision, the risk, potential risks associated, and do you actually own what you're setting out? It's once again that sounding truth to and those that have got a good overview of it all get 10 points in my box.
Oh, thanks, Kylie. Look, that's very good. And I guess I'll put this into my language as well. Pardon me, because having been involved in a number of proposals to lenders, what we are encouraging our clients to do is to take all of these elements using the words that Kylie has spoken and put them into the business plan, put them into the financials, so that's past, present and future, and also into the loan proposition, so that every step of the way a lender, I guess, reads and hears, including the time that we sit in front of a lender representative, which would be ourselves as advisors and our clients, so that consistently the same message comes through in writing and in financials and in the verbal discussion. So I guess is that a reasonable summary before we move to the left-hand side, Kylie?
Yeah, very much so, Gordon. And when we're looking forward to say these is the vision and this is what I'm setting out to achieve, we've also got to look a little bit in the rear vision mirror to check, are those goals actually able to be achieved as well?
Okay, sounds good. So Kylie, on the left-hand side, we talked about the risks. So what are the key risks? So we've got to identify what the risks are, how we're going to manage them, what if they become a significant problem, what if they're not, how are we going to deal with them or mitigate them. We talked about the idea of operational risk, which people are probably familiar with from a production point of view. We're going to move on to business risk in a wider sense in a moment. Then one thing that has always come to mind is, we'll call it what you said a couple of minutes ago, which is the intent to actually implement the plans. and the intent that the financials will be followed as a way of demonstrating capability to implement the plans. And then when we were talking the other day, you talked about the risk review and updating process. So any comments on the left-hand side before we move on?
I think this leads back, excuse me, coming back to the previous slide with the 12 pillars, and using those as the headlines. And then these are the subtopics to, I guess, go through on each of those. And feel free, branch out and use more than just those 12, but that's a great starting point. And then these are the sub things to cover off on.
So, for example, what risks, how are you going to manage them? What if things go astray or they go according to plan? And that whole risk mitigation process. And then operations, business plans, and financials. That's pretty much the take-home message.
Absolutely.
Look, just a question from left field before we move on. When it comes to those regular reviews on a quarterly or 6-monthly or annual review basis, how do you sort of tackle your risk reviews from that perspective? Is that like forensically going through the financials, forensically going through the business plan, sitting down in front of a client, or all of the above or less of the above?
It's a little bit on all of the above, and working through some of these things, for example, succession, and the really long-term goals. When we speak of it, it's more potentially just a check-in to say, look, last year you said we've got 4 people in the business, we've got key person insurance and life over mum and dad and the 2 brothers. And if something was to happen, this is the steps we're going to take. At an annual review or a check-in, it's more so, hey guys, is that what you're still planning? Yes, we are. Tick, move on. If it's not, then we flesh it out further. Whereas then coming back into, from a cash flow and a production point of view, we would delve into that a lot more in detail, because we're looking at what's coming up in that next 6 to 12 months. And analysing on the cash flow perspective and capacity.
So that allows us, Kylie and I, to have a slightly different conversation around business risk on the basis that half the people are pretty comfortable with their production, and the other half, or let's say a third, roughly got their business risk from their perspective a bit sorted. And my thinking is that everyone could listen to this and ask themselves, from a checklist point of view, have I got all of these things under control? So Kylie, we did our little diagram here on the right-hand side when thinking about business risks. And we started at the top and thought, as you said earlier, how do I make money? The second thing is, how am I going to manage the growth? What resources do I have, and do I have all of those resources in order? The third piece, which is on the bottom right there, is order and structure around governance. And so that's starting to delve into a very disciplined approach to doing business. Key man risk, you talked a little bit about succession, but I guess from our point of view, that's one of the things we like to touch on, because I've had many examples of people who've said, if that bloke there or that woman there dropped off the perch, we'd be in big trouble. And particularly if the business is growing, that's a big risk. That communication engagement and some of the specifics about goals and planning that you've already touched on. And Kylie, maybe I'll just bring up the left-hand side as well, and you can comment on all of this. So we talked about management capability, people, financials, the planning process, and the factors affecting what will work and what doesn't work. So Kylie, over to you to, I guess, give us your view on business risks in a bigger picture sense.
Absolutely, and as you've said there, it's generally people's goal throughout whatever it is, the money is critical to it all. So how am I going to do that? Understanding those markets and price, and how am I going to protect that along the way? Am I using forward sales? Am I looking into different markets? Do I have to think outside the box, joint ventures, to capitalise and make the most of what produce I'm making. Which then leads into the goal then to grow the business. And most people I speak to are looking to expand and diversify. So ultimately, cash is king to be able to pay for that. And what we're seeing lately is this is from a external point of view, production point of view, finance, that governance is our operation authority to operate, really. And making sure that we're dotting I's, crossing T's. Everyone's now working on the chem cert and animal welfare and all those aspects of things that can go wrong and make sure the paperwork's in place. So that's something that we're seeing is probably starting to spend more time in the office. I know a lot of producers don't like being in the office and doing paperwork, but I think it's key to be dedicated, to set aside time, bite-sized chunks, whether it's once a fortnight, once a month, at the absolute minimum, to sit down and just ensure that you're across everything from that perspective. And key man risk is touched on, Gordon. Like, if we've got to sit down and say, yes, what happens if someone within the business is removed? It may be that it's an accident, life has taken them away because a child is ill, or unfortunately it's death. You say, okay, what would we as a business then do from that perspective? One thing to speak on, and it's probably led through accountants and financial planners, is to look at insurances. However, understand that if insurance was free, we would hock it up to the hills. But unfortunately, it's a very expensive product in general. So it's then understanding to what level do I require that in my business, and how much cash flow can I afford to put towards that. Along the lines of that, if it's a very asset-rich business, it might be to say, well, you know what, we do have a bit of debt, but if something was to happen to Dad, we would sell the back block, because that would reduce debt, and from an operational perspective, we can then continue this business with the remaining people in place. So it's just some of the things to think about and put some scenarios down. Understand that of these, there are some things that you can control, and there's some things that you can't. And for anything that you can't control, don't let it stress you out too much. Be aware of them, because sometimes they may near in and become in the box that you actually can control.
Okay, thanks, Kylie. One observation I'll make before we move on, because it has been an experience that I've had, and it's to do with key man risk. And it's happened a couple of times to some of our clients, which is even a family member or some key person in the business has said, I've had enough, I need to leave, here's 2 weeks notice or 4 weeks notice or whatever it is. And people don't see that sort of thing coming. And to me, that's kind of one of the things that really constitutes a significant element of key man risk that we may not have thought of. I mean, people dying, getting ill and all that sort of thing, maybe we vaguely thought about that, but some key person just appearing out of the woodwork and saying, I'm done, I'm going, is often quite a shock to the system. So I just wanted to, I guess, put that one on the table as well. So Kylie, I'm going to maybe give a quick summary about what does the future hold, and ask you to make a couple of comments about it at the end maybe. So as I'm a somewhat interested party in what the trends are in the lender readiness arena, what I've noticed of late is that the Australian Prudential Regulation Authority is becoming quite active in regulating or observing what needs to be done by banks, which is a second dot point, and the duties of the banking fraternity when it comes to climate variability, climate change. So we'll call it climate disasters. I noticed that there is also some focus there from the insurance and superannuation industry. So my thinking, and what I'm starting to pick up from some lenders, is that once these issues become, I guess, on the horizon or on the radar of regulators and government, and they trickle down to banking institutions, then my expectation is the next place they're going to trickle to is us as borrowers, which means they have to be incorporated into our planning, into our best practice and our risk assessments. The next thing is being involved in some industry organisations as I am. I've picked up that organisations like the Red Meat Advisory Council, National Farmers Federation, sundry others are looking at these things on the right-hand side quite actively and saying they are industry risks. So climate, droughts and floods, opportunities through the clean, green, sort of grass-fed or sustainability type elements, looking at social license to operate around welfare and sundry other things. And then more recently, the Future Drought Fund linking innovation and we'll call it disaster mitigation. To me, these are the sort of things that we all have to be aware of. And I've actually spoken to some banks who are saying, look, come 2022, 2023, it may well be that we look very actively at what the implications for borrowers are around this whole climate question. So I guess the question I'm posing to myself, particularly as we adjust our business plan and financial forecast templates, is the question being posed to clients, which is, are you integrating this thinking into your planning? So I know, Kylie, you're a bit more focused on the operational side, but do you have a comment about any of these points?
Yeah, Gordon, I think that's it's hot on the lips of the globe at the moment from that climate variability and how do we minimise that footprint. And as large organisations, we're getting a bit more heat on us at the moment and watch to make sure that our social licence to operate is in check, and that's ultimately then going to filter down to our clients. So I think yeah, you're right on the money. Over the next sort of 12 to 18 months, we're going to start seeing some practices come into place and questioning around it as we move forward on that carbon neutral plan.
Okay, thanks, Kylie. So I just wanted to flag that, I guess, because we're dealing with the here and now, but you know, things are going to change. So Kylie, I've paraphrased also your thoughts about some of the key messages out of this webinar, which might set up our Q&A session. So you've talked about business best practice, so that's, I guess, the first one. You've talked about these specific risks, particularly goals and so on. I know you're quite, I guess, definite about the idea that people ought to do their best to think about everything that might come up, but things that are unexpected do arise. So that's why I'm thinking that you might like to comment on those points before we move to the Q&A session.
Yeah, absolutely. And as I say, for those that are stuck on where to start, just jump on to Gordon's website to print out the pillars of best practice and start thinking along those lines. Even as you speak to the accountant or any of those advisors in your core network, it's great to challenge each other. So if a bank manager asks something of your production because they see it as a risk, don't take offence to it. It's just someone else looking in from the outside to find have we thought about everything? Are there ways to improve your business? Like, we're all on the goal to achieve. So yeah, you've summarised everything down there for me, Gordon. But don't keep it awake at night when you can't think of anything else to add to the list. Okay,
just kind of get on with it, but be aware.
That's it, and also be flexible, because as you say, things pop up. So be flexible and agile within that.
Okay, thanks, Kylie. Greg, I'm aware that time is marching on, and it may be that there are some appropriate questions to fire at Kylie or to me. Is there anything there that you need to make us aware of?
I don't see any questions at the moment, but one of the things we will lead into the Q&A now, and as you can see down the bottom of Gordon's slide there, with regard to the Q&A session and the questions that you're thinking about, maybe if we focus on those operational elements of getting the money and what are the business risks that we're doing it, that sort of thing. I'm just scanning Okay, one of the questions that has come in is what sort of sensitizations do banks place on budgets?
I think that might be a Kylie question. Any comments about that, Kylie?
Yeah, it's everyone might have a slightly different approach on it. For me personally, if I get a budget that sets out assumptions and production assumptions that feel achievable, and especially for a business that has been in business for a number of years as opposed to a startup, and you can sense check that those assumptions have been achieved in the past, i.e., yes, this is a cattle grazing operation. They have been consistently able to turn off cattle within this weight range, now overlaid with the current market price, and their expenses have been operating at, say, 55% historically. Their cash flow is assuming their operating expenses are still around that 50 to 55% mark. To be honest, I don't sensitize that. I take that as the word. However, in the case where the business has previously only been able to achieve 50% of that production, and the expenses, for example, are instead of 55%, now they're down at 20%, that's when we start having to look at sensitizing to say, look, this feels a bit too optimistic. Let's try and bring that little bit back down to what we have seen the business be able to achieve in the past.
Okay, thanks, Kylie.
Okay.
Anything else?
No, there's no other questions that have come in at this stage. That was the only one that has come in. Another one that's come in just now. What about prices for sales of stock and grain? Do you consider them?
Absolutely. And so in a forecast going forward, just because what's happened in the past doesn't necessarily always flag what's going into the future, if let's use wheat, for example, and you say, okay, for my next 12-month forecast, I'm putting a price in at $350 a tonne. I would then want to understand how are you protecting that price, and whether that's going to be potentially forward sales to start looking at that as an average. So anything that is made as an assumption in that cash flow going forward, what measures are you putting in place to achieve that ultimately at the end of the day, or make that either your average or your bottom price?
Okay, understandable. Thanks, Kylie. There's no more questions, Gordon, so I'll just hand back to you just to go through the slide that you got there.
Sure, thanks very much, Greg. I'm very aware of time too as well. So I've simply provided my information and Kylie's information there in the event that somebody wants to contact either of us. As I've explained, this is all part of our wider Lender Ready program, where we're taking the information that we've described in today's webinar. We've actually got a series of templates, briefing papers, and systems which we've used in the past to engage with lenders like Kylie. And so this Lender Ready program includes access to that material, access to the briefing papers, access to ourselves, access to some specialty webinars, and access to group programs or group discussion. So that's the reason why, even though this is largely an online program, we actually schedule a starting date to get a group of people who might want to go on the journey together. So that first program is starting on the 1st of November. So we'll keep you all in the loop about capacity to get involved in that. And Greg, this is our sort of traditional disclaimer, which is letting people know that this is general information, and that what the Lender Ready program is about is helping people figure out how it might work for them to create their own materials. So Greg, I'll hand back to you and thank you and Kylie for everything you've done to make this a success today.